Hello, welcome to latest wealth online classes. My dear friends, we have been learning about fundamental analysis. How to do the fundamental analysis in earlier classes. In the fundamental analysis steps, let me remind you once again. First is we have to read financial statements from the annual report. Then in the financial reports, one is profit or loss account, balance sheet, cash flow statement, and we discussed about ratios, operating ratios, financial ratios, and value ratios. Today, you are going to learn about DCF primer. What is this DCF primer? My friends, in the previous chapters, we understand that stage 1 and stage 2 of equity research. Now, stock price. This is today's our heading. In previous chapters, we understood stage 1 and stage 2 of equity research. Stage 1 deals with understanding the business and stage 2 deals with understanding of the financial performance of the company. One can proceed to stage 3 only if he is convinced with the findings of both earlier stages. Stage 3 deals with stock price valuation. An investment is considered a great investment only if a great business is bought at great price. Let me repeat. An investment is considered great investment only if great business is bought at great price. That's what in real estate there is one proverb, love the deal, not the property. This is one funda, love the deal, not the property. Second is, in real estate, you make profit when you buy, not when you sell. But it is a bouncer for most of the people. Yes, my friends, in real estate actually you make profit when you buy, not when you sell. Same the way here in the stock market, a great investment is considered to be great investment when it is purchased at great price. So that what happens when you are purchasing itself, almost you are making a profit. In fact, I would even stress to say that it's perfectly fine to buy a mediocre business as long as you are buying at great price. This only shows significance of the price when it comes to investing. The objective of next two chapters is to next two classes is to help you to understand the price. The price of stock can be estimated by valuation technique. The valuation per se helps you determine the intrinsic value of the company. We use valuation technique called discounted cash flow. That means DCF method to calculate intrinsic value of the company. The intrinsic value as per the DCF method is the evaluation of the perceived stock price of a company, keeping all the future cash flows in perspective. The DCF model is made up of several concepts which are interwoven with one another. Naturally, we need to understand each of these concepts individually and then place in the context of DCF. We will understand the core concept of DCF called net present value, NPV. I'll repeat, the net present value, NPV, and then we will proceed to understand the other concepts involved in DCF. So before understanding DCF as a whole, first you have to understand net present value. Now let us go. The future cash flow. What is the future cash flow? The concept of future cash flow is the crux of the DCF model. We will understand this with help of a simple example. Let us assume Kiran is a pizza vendor who serves best pizzas in town. His passion for baking pizzas leads him to an innovation. He invents one automatic pizza maker which automatically bakes pizzas. All he has to do is pour the ingredients required for making pizza in the slots provided, and within 5 minutes, fresh pizza pops out. He figured out that this machine he can earn around revenue of rupees 5 lakhs and that machine has a lifespan of 10 years. His friend George is very impressed with Kiran's pizza machine. So much so that George offers to buy the machine from Kiran. Now there is a question for you. What do you think is the minimum price George should pay to Kiran to buy this machine? Well, obviously, answer to this question we need to see is how economically useful this machine is going to be George. Assuming he buys the machine today, we are calculating basis year as a 2014. Over the next 10 years, machine will earn him 5 lakhs each year. Here, how George's cash flow in future looks like this. See here the table 2015, 16, 2017, 2018, 2019, 2020, 2021, 2022, 2023 and 2024. See here 5 lakhs, 5 lakhs, 5 lakhs, 5 lakhs, 5 lakhs each year as mentioning. Please note, for the sake of convenience, we are assuming that machine will start generating cash from 2015. Clearly, George is going to earn 50 lakhs, 10 into 5 lakhs over the next 10 years, after which the machine is worthless. One thing is clear, at this stage, whatever the cost of the machine, it cannot cost more than 50 lakhs. Think about it. Does it make sense to pay an entity price which is more than the economic benefit offers? To go ahead with our calculation, assume Kiran asks George to pay X towards the machine. At this stage, assume George has two options. Either pay X and buy the machine, or invest same rupees X in a fixed deposit scheme which not only guarantee his capital but also pays him an annual interest of say 8.5%. Of course, it is not available, say 8.5%. Let us assume that George decides to buy the machine instead of fixed deposit alternative. This implies George has foregone opportunity to earn 8.5 risk-free interest. This is the opportunity cost for having decided to buy the machine. So far in our question to price the automatic pizza maker, we have deducted three crucial bits of information. Number one, the total cash flow from the pizza maker over the next 10 years is rupees 50 lakhs. 2. Since the total cash flow is known, and it also implies that the cost of the machine should be less than the total cash flow from the machine, the opportunity cost for buying the pizza machine is an investment option that earns 8.5% interest. Now, keeping the above 3 points in perspective, let us move ahead. We'll now focus on the cash flows. We know that George will earn rupees 5 lakhs every year from the machine for next 10 years. So, think about this. George in 2014 is looking at the future. 1. How much is rupees 5 lakhs that he receives in 2016 worth in today's terms? 2. How much is rupees 5 lakhs that he receives in 2018 worth today's terms? How much is rupees 5 lakhs that he receives in 2020 worth in today's terms? To generalize, how much is the cash flow of the future worth in today's term? The answers to this question lies in the concept of time value of money. Time value of money. In simpler words, if I can calculate the value of all the future cash flows from that machine in terms of today's value, then I would be better situation to price that machine. Please note, in next section we'll move away from pizza problem, but we'll eventually get back to it. We'll come back once again. Now, the time value of the money. Let us go into topic time value of the money. Time value of the money plays an extremely crucial role in the finance. The TMV finds its application in almost all the financial concepts, be it discounted cash flow analysis, financial derivatives pricing, or project finance, calculation of annuities, etc. The time value of the money is applicable. Think of the time value of the money as an engine of a car, with car itself being the financial word. The concept of time value money revolves around the fact that the value of money does not remain the same across the time, meaning the value of rupees 100 today is not really 100 2 years from now. It is sure. Another way, the value of rupees 100 2 years from now is not really 100 as today. Whenever there is a passage of time, there is an element of opportunity. Money has to be accounted or adjusted for that opportunity. if we have to evaluate that what would be the value of money that we have today sometime in future, then we need to move the money today through the future. This is called future value of the money. Likewise, if we have to evaluate the value of the money that we are expected to receive in future in today's terms, then we have to move the future money back to today's terms. This is called present value of the money. In both the cases, as there is a passage of time, the money has to be adjusted for the opportunity cost. This adjustment is called compounding. When we have to calculate the future value of the money, it is called discounting when we have to calculate the present value of the money. Without getting into the mathematics involved, don't worry, it is not high-fi maths, very simple maths. Actually, it is very easy. I will give you the formula required to calculate future value and present value, FV and PV. Example, how much is rupees 5,000 in today's terms? For example, I am basing as a 2014. Worth 5 years later, assuming an opportunity cost of 8.5%. This is a case of future value computation, as we are trying to evaluate future value of the money that we have today. Future value is equal to amount multiplied by, just see here within the brackets, 1 plus opportunity cost to the power of number of years. That means is equal to 5,000 into 1 plus 8.5 to the power of 5, that is 7518.3. This means rupees 5,000 today is comparable with rupees 7518.3 after 5 years, assuming an opportunity cost of 8.5%. Example 2. How much rupees 10,000 receivable after 6 years worth today terms assuming an opportunity cost of 8.5%. This is clearly the case of present value computation, as we are trying to evaluate present value of cash receivables in future in terms of today's value. Present value is equal to amount divided by 1 plus discount rate to the power of number of years. See here, when it comes to numbers, it will be equal to 10,000 divided by 1 plus 8.5% to the power of 6. That is equal to 6129.5. This means rupees 10,000 rupees receivable after 6 years in future is comparable to rupees 6129.5 in today's terms, assuming discounted rate of 8.5%. Now let us go into example 3. If I reframe the question in the first example, how much does 7518.3 receivable in 5 years worth in today's terms given an opportunity cost of 8.5%? See that I am reversing the question. We know this requires us to calculate the present value. Also, since we have done the reverse of this example, in example 1, please refer example 1, we know that answer should be rupees 5,000. Let us calculate the present value to check this. Is equal to 7518.3 divided by 1.85 to the power of 5. That means 5,000. Assuming you are clear with the concept of value of money, I guess we are now equipped to back to pizza problem. Now, the net present value of cash flows. We are still in the process of evaluating price of pizza machine. Please remember, we know George is entitled to receive stream of cash flows by virtue of owning a pizza machine in future. This cash flow structure is as follows. 2015, see here, 2015, 2016, 2017, 2018, 2019, 2020, 2021, 2022, 2023. Already it is mentioned that 5 lakhs, 5 lakhs, 5 lakhs, 5 lakhs, like continuously for 5 lakhs. We posted this question earlier. Let me repost it again. How much is the cash flow of future worth in today's term? Let me repeat. How much is the cash flow of the future worth in today's term? As we can see, cash flow is uniformly spread across the time. We need to calculate the present value of each cash flow receivable in future by discounting it with the opportunity cost. Here is a table that calculates PV of cash flow keeping the discount rate of 8.5%. See here, look at the table. It is year, cash flow, receivable in years, present value in rupees. 2015, cash flow is 5 lakhs, receivable in 1 year is 1 year, so that present value will be only 4,60,829. That means even though you receive 5 lakhs next year, if you compare with the present day cost, it is going to cost only 4,60,829. In 2016, cash flow is 5 lakhs, receivable years is 2, it will be equivalent to 424,808 rupees today. Next 2017, 5 lakhs is at 3 years, then amount will be equal to 3,91,481. In 2018, 5 lakhs, 3,62,802. 2019, 5 lakhs, 5 years, 3,32,535. 2020, 5 lakhs, 3,06,485. 2021, 5 lakhs, 7 year, 282,470. 2022, 5 lakhs, 8 years, 2,60,335. 2023, 5 lakhs, 9 years, 239,946. 2024, 5 lakhs, 10 years, 221,151. Total 50 lakhs, but when it comes to present value, it equivalent to 32 lakhs 80,842 rupees. The sum of all present values of future cash flow is called net present value. See here, net present value. The NPV in this case is 32 lakhs 80,842. This means the value of all the future cash flows from pizza machine in today's term is 32 lakhs 80,842. So if George has to buy the pizza machine from Kiran, he has to ensure the price of rupees 32 lakhs 80,842 or lesser. But it definitely not more than that. And this is roughly how much the pizza machine should cost George. Now think about it. What if we replace pizza machine with the company? Can we discount future cash flows at that company earns with an intention of to evaluate the company's stock price? Yes, we can add. In fact, this is exactly what we'll do in the discounted cash flow. Now let us revise what we learned. 1. The valuation model such as DCF model helps us estimate the price of a stock. 2. The DCF model is made up of several interwoven financial concepts. 3. The time value money is one of the most crucial concepts in finance, as it finds its application in several financial concepts including DCF method. The value of money cannot be treated as same across the time scale, which means the value of money in today's terms is not really same at some point in future. To compare money across the time, we have to time travel the money after accounting for opportunity cost. Future value of money is the estimation of value of money we have today at some point in future. Present value of money is the estimation of value of money receivable in the future in terms of today's value. The net present value of the money is the sum of all the present values of the future cash flows. My dear friends, hope you understand what is the net present value in DCF model. Please, if you are not followed, watch 2 or 3 times, and along with the study material, we are going in a step by step. Watch once again with the annual report, and please remember, more you enjoy the process, more money will be making. Enjoy the process, enjoy the life, be wealthy. Let's meet in next class. Till we meet again, enjoy every bit of life. Have a nice day. Thank you. Kailash is logging off. Bye bye.